Hello, everybody. Welcome to Clef Investments. Today, let's talk about Tail Hedge. This is the last strategy I want to discuss, which is combining stocks and options. So, Tail Hedge is a strategy that's highly recommended by Mark Spitznagel's book, The Dawn of Capital. And many people call it the Tail Hedge strategy. This is a good book. So in this strategy, basically every month you spend 0.5% worth of your portfolio to buy put, and you buy far out of money put, which is more specifically 30% lower strike than the current price. This is a very far out of money put and it's very cheap. And if you need to buy 0.5% of them, you need to buy a lot of them. And then you buy puts that will expire in 2 months. After 1 month, you will renew them, basically sell them and buy more puts that's 2 months to expire. So that's called a rollover. And you keep doing this. If puts get you some more money, you can use the extra money to buy more stocks. But if put drops in value, you don't have enough money to buy put. You would have to sell stock to get the money to buy the put. So because you buy a lot of put, if the market drops a lot, you make good profit. So basically, if the stock goes up, you make money. If the stock goes down by a lot, you also make money. So that's the basic idea of tail hedge. It is used to protect your portfolio against extreme risks. So if you look at the picture of the tail hedge on the right, the top right picture is a more zoomed in picture. The x-axis is the value of the stock, the S&P 500. And the y-axis is the profit loss. So you can see if the stock doesn't move much, you can lose lots of money. But if the stock goes up or goes down by a lot, you make money. And the bottom right picture shows you a more zoomed out figure, where you can see a wider range of the stock price. And you can see that if the stock drops a lot, you can make huge amount of. This is because the put in the tail hedge has a much lower strike than normally what people would do in a married put. So that means if the stock doesn't drop enough, the put will not protect you. And the theory here is stock price moves in a fat tail distribution, where it moves much bigger than the normal distribution. And because the put is very far, the money is very cheap. So you buy a lot more put to protect more than your stock portfolio. And that's why the price can appreciate if the stock drops by a lot. So compared to married put does not lose money when the market drops. So basically on the left side, it's a flat line. But for the tail hedge, you make a lot of money when the market drops by a lot. So I actually did a back test of the tail hedge. I tried from 2005 until 2021. So that's the options data I bought. And if you do buy and hold on the S&P 500, the annual appreciation is 8.35%. So basically, if you invest 10K at the beginning of 2005, after 16 years at this rate, you get about 36K. But with tail hedge, with the parameter suggested by Mark in the book, you would get 9%. So which means 10K would become 40K. And that's 11% better. So this strategy in the real market, if you invested it in 2005, it would actually outperform buy and hold. So that's a good thing. Now let's look at the max drawdown. The drawdown means how much it has pulled back from the previous high price. So for the buy and hold, the max drawdown happened at 2008. It's more than 50%. It's 56%. But for the tail hedge, it's only marginally better. So this is very disappointing because you bought lots of put. You hope to protect the portfolio, but your portfolio can still drop more than half. And my backtest also considered a very high capital gain tax. But overall, in all your profit, only you spend 7% in your profit because most of the stocks you buy and hold, you only sell very little to pay for the put. So the overall tax rate is not too bad. It's only 7%. And I also simulated the commission, which is less than 0.5%. So that's insignificant. And this is because I assumed I'm using SPX options. So I buy SPY and I use SPX. SPY is a S&P 500 ETF. And its price is only 1/10 of SPX. So that means if you buy SPX options, you only need to pay 10% of the commission because the contract size is 10x bigger than SPY. If you use SPY, you would pay 3.5% in commission. That's a big no-no. That's way too much. And the commission rate, I was using what I can get from Interactive Broker. So for this strategy, I think the main problem is the max drawdown is not getting better. And every month, you have to pay 0.5% of your portfolio to buy puts. So this is something most people cannot do, and I cannot do it. If I have lots of money, every month I guarantee to spend 0.5% on put, and most of the time, the put will depreciate by a lot when I roll it out in the next month, or even almost expire worthless. So you need a very strong nerve to do this strategy, and I highly recommend you do not do it unless you think you can. So I read a blog about this. Somebody was following this strategy. He followed it by a long time, and he kept losing money, and finally he gave up. And he gave up right before pandemic at the beginning of 2020. And then in March 2020, the market drops so hard. If he had been continuing to do that strategy, he would make back a lot of loss he has got in the past many months. But he didn't get that far. If I do that strategy, I don't know how long I can last. Very likely, I'll lose a lot of money and stop doing it before the real market crash comes in. And nobody can predict when the market can crash. So this is not a strategy that our average investors can do.